Having an advisor is useful, and how what that advisor should do for you, you should know, because some advisors are able to influence your behavior and some are good at managing money. They are two completely different skills. You could have an advisor who is very good at advising and tell you what you should do to achieve your goals and make sure that you don't stop your SIP, increase your SIP, or do some monkeying around with the portfolio. He is not the portfolio manager, and he could take you to a good portfolio manager. That is that advisor's role, and this is the portfolio manager's role. Don't blame the advisor if the portfolio manager is not performing. Blame him for the process by which he chose him. So understand the role of your advisor. It's like going to a gym. The role of the trainer is to make sure that when you lift, whether you hold the grip like this or grip like this, or right, all those things matter, right? Whether when you're doing a chest press, is the pressure on your chest or is it on your shoulder? A good coach will be able to do all those things. He will not be able to, your body won't get built because you got a good coach. You will build a good body because the coach was good, he said the right things and you listen to him. This combination is required in the investor, advisor and portfolio manager. See whether you're building those things. I've always used an advisor from 1979 till 2022. But it's your choice. Some people think that they can pick up ETFs and some passive funds and that will work for them. It's your choice. I do a combination of everything, right from PMS, which is very small, and mutual funds, direct equity. I have the full range, right? So you have to make your own choice. Sometimes I have lost money by selling early. Infosys, I made the mistake of selling early. Sometimes I make the mistake of holding on for a long time and then and losing money. So all this was learning. So nowadays I don't let my losses run, I let my profits run deep, right? I have made a mistake of selling early in Infosys, and I have held on to HDFC Limited and HDFC Bank for an extremely long period of time. I made money by selling MRF at the right time and then again buying it back when it fell, right? Same thing I've done in LMW, I've done in Bosch. You have to know that some strategies will work sometimes, some won't work. Some shares you sell off and it just goes off, you'll never be able to touch it again. I have then learned that I could keep buying. I could be selling when it is coming down in lots. I could be buying when it is going up. Doesn't matter. There's no best price to buy and best price to sell. If you're making money, it's good for you. Sometimes selling early is hazardous, sometimes holding too long is hazardous, right? Both could be right. Sometimes this is right, sometimes that is wrong. Sometimes both are wrong, sometimes both are right. So it's a very liquid state of the market. So you have to choose what suits you and what does not suit you. In equity, there is you get rewarded for sitting for very long periods of time doing nothing. That's also not easy. You're itching for action, you want to do something, then trade in 100 shares or 200 shares. Let's say you have 10,000 shares of XYZ, you trade in 200 shares, you trade in 300 shares. There is some action. It does not mean you have to trade in 10,000 shares. Reduce the ticket size when you are itching for action, because don't disturb your core portfolio, which is anyway doing well, right? So don't do that. Holding for the long term can mean holding for decades, right? Not just for a few years. So when I'm talking of holding for a long term, what it means is you buy a share because you like it and then you keep monitoring it for some time. After some time, that monitoring is not needed. It is exactly like planting a seed. When you plant a seed, the seed doesn't look like the final output tree, the mud doesn't look like the final output tree, the water doesn't look like the final output. What you're going to get is a sapling, which you have to again nurture for some time, and after 10 years or 5 years, 7 years, you don't need to do anything. The tree will go and find its own water and it will live. You don't have to water it, you don't have to put a fence protecting it from other animals, etc., right? You don't need to do any of those things. Exactly like that for your portfolio. When you buy a share, monitor it for some time, look at the quarterly results, etc. Then you like it, you keep it. You don't like it, you get rid of it. So this also means that when somebody asks me, can you give me some 10 shares which we can buy and keep it for the rest of our lives, I'd say it's not such an easy decision. Holding on to a share for 40 years means, at least in the initial 5 years or 3 years, it means 12 decisions to keep it, because every quarter you're seeing what is happening. Did they say something and achieve it? Is the share price going down? If it is going down, is it going down faster than the industry or from the whole overall market? Look at all those things as parameters. So it's not always a buy or sell decision on day one. On day one, yes, it's a buy decision. Then there are 4 hold decisions every year. So if it is 40 years, at least you have taken 20 decisions, if not 160, saying, okay, this is a problem, but I'll still hold. This is a problem, I'll still hold. Oh, this is a problem, I'll sell partially. All these kind of things happen. Nobody buys, say, HDFC Bank in 1978 or HDFC Limited in 1978, bought 10,000 shares and now holding the whole thing. Whole thing means that 10,000 plus split in bonus and rights and all that. That never happens, because it takes time for you to decide, oh, this is a good company, this is great company. So after 1995, maybe after 2000, I'm not sold HDFC Limited. But 1978 to 2000, of course I had to sell, because you don't know whether it is worth holding or no. It takes time for you to know, learn and establish. There's a book which says just keep buying. So typically you are doing multi-asset investing. Most of you. I'm largely an equity investor, but most of you are investing in equity, in real estate, in gold, in putting some money away in debt funds. You're doing this, right? So if I can create a multi-asset fund for you, which says 60% in equity, 10% in debt, 10% in gold, or some 10% in REITs, something like that. And then you have to do nothing except keep on doing an SIP in that. Whatever is your asset class, just keep buying, because you know that the human mind is capable of surmounting all the problems. So was this Chinese COVID a problem? Yes, but the whole world coped with it, right? You have to be sure about the world's coping mechanism. Some companies may not cope, many people may die, all these things will happen, but the world at large copes up with the problem and comes out of it. Therefore, in the long run, equities make money. But please also remember, almost all equity literature is American. But at a time when America was dominating the world, it could manipulate anything. United Nations and all of them, everybody was listening to them. We do not know what is going to happen in the future. So will this always work? I think so, but I'm not very sure. Position sizing is very important. I learned it from Naren largely, and that was very useful for me, because you could just pick up 200 shares of a company at 80 rupees, and when the price is 400, say, oh, I have 200 shares. It doesn't make sense. You have to keep building a position enough for you to make that effort of doing research, knowing the promoters, or learning about the promoters worthwhile. Otherwise, it's not worth doing equity investment by not committing enough money to the idea which you like. So you should go between 5% to 17-18% in any script. Otherwise, it's not worth it. Otherwise, it's just a position which is there. You bought 200 shares, you bought it at 400, it became 500, you sold off. That is not what I'm talking about. When you invest, build a position, learn about portfolio sizing. Find yourself an investment club or investment buddy with whom you can talk, with whom you can chat, maybe who has a YouTube channel, somebody who has Twitter feeds, all that, so that, because this is going to be dull and boring. And to avoid the monotony, if you start trading, you will hurt yourself very bad, right? So build your investment club, which meets every week, every month, every day, depending on your level of enthusiasm, and you decide there, right? So there is no question of you taking away somebody's idea or they taking away your idea. You go, sit there, talk. It's pretty lonely out there, so you need to create your own forums. For us, we had the advantage of going to Dalal Street, so which meant we met a variety or range of people who would all be happy talking about equities through the night also, right? So we could find that in a physical way. You have to do it in an online fashion or in a physical way.